So this video's problems are all about the LIFO reserve. This is an exceptionally important account because most companies do use LIFO for their cost flow assumption. If they do, they are required to have a LIFO reserve. The idea is they want to allow users of financial statement information to compare COGS and inventory turnover for two companies, regardless of what cost flow method they use. And by using LIFO reserve, we can undo what LIFO accounting did or apply LIFO accounting to a non-LIFO company. So it's a really useful tool for putting financial statements on par if they're not in the same inventory system. Now, I'm going to work this problem and we're going to talk a little bit about what the LIFO reserve is and what it does. In this case, the company is using a FIFO cost assumption, but they're using that in their ledger. So a company may use a non-LIFO in their ledger, and that's okay. If the company is going to report using LIFO, because it's not their ledger accounting, but they want to put their balance sheet and their income statement in LIFO terms, then this is when they use a LIFO reserve account. It goes on to give me the balance, the beginning balance of 100,000. This is according to the FIFO cost assumption measure. And its inventory, its ending inventory is recorded at a balance of 170,000 on 12/31/20. So I'm going to go ahead and just make a record of that and set up the T account. It started at 100,000, went up to 170,000. Okay. Not worried about the increase or all the transactions that might have gone into this, but we'll see where these balances play out. But remember, this is FIFO because we're talking about their account, their T account, which is really in their ledger. And this is how the company maintains its records internally. Right? Now, it goes on to say that the company uses LIFO to determine taxable income. And remember, if a company does this for their taxable income, and by this I mean the IRS tax taxable income, not the income statement income, because those are two different things. So if a company is using LIFO for their IRS return, then remember that the LIFO conformity rule requires us to use LIFO when calculating our income statement income. Okay. So the company has this dilemma where it's reporting its ledger in FIFO terms, but because it wants to use LIFO for taxable income, it is required to report inventory balances on their balance sheet at 60 and 90,000. So I'm going to present this in a slightly different way, even though we're talking about the same dates, because this is not a ledger. The company doesn't keep a ledger in LIFO inventory, but this is what we're seeing or would be reported on a balance sheet. $60 and $90 for those 2 years. Now, remember, this is not our ledger, but this is our balance sheet because a lot of stuff that we do in ledgers, we don't necessarily want to put on our financial statements. And this is one of those moments where we're going to have two ledgers that create what we put on our financial statement. So, how the company actually makes this change is through a contra asset, which is hopefully you understand by now, the LIFO reserve. And this contra asset, like all contra assets, will pair up with a primary account, in this case, the inventory account, and it just acts as a modification to this account when we put it on a financial statement. So instead of reporting 100,000 for the beginning of the uh, year inventory or the end of the prior year, 2019, for that piece, 100 becomes 60 because there's a $40,000 contra balance in this account that would be subtracted from 100 when we present on the financial statement. Okay. Same story with the ending balance for this year. 170,000 gets reduced to 90,000 because this account needs an $80,000 contra credit balance here to reduce it to that amount, to what they reported on the balance sheet. So basically, we're just taking our knowledge of one account, one ledger account, and what got reported on the balance sheet to reverse engineer what had to be in the LIFO reserve account, right? But it doesn't get to 80,000 by itself, so we still have to make an adjustment. This is kind of like the bad debt expense adjustment, where we're making an adjustment to go from in this case, the beginning balance to the ending balance. And we need a credit, and clearly that credit needs to be 40,000. So we're crediting the LIFO reserve by 40,000 and then debiting cost of goods sold. So this adjustment, and do remember it's an adjusting entry. This adjustment will reduce my net income further because I am debiting cost of goods sold. This is what I have to change my cost of goods sold by to go from the non-LIFO cost of goods sold to a LIFO cost of goods sold. And this adjustment in my LIFO reserve account is what I need in order to translate my ending non-LIFO inventory to an ending LIFO inventory balance on the balance sheet. So once you have that idea figured out, and I know that's probably more than you bargained for when you jumped into a problem video, right? But you got to understand that in accounting, the numbers are pretty simple. Like I'm not doing a lot of fancy math at all. Right? Fancy math being I'm subtracting things, right? But it's about where you got to pull the data, what the data mean, and then understanding the story behind it to really get at that level of mastery that we want at the 3000 level course. Right? So then let's look at, so the first one, let's apply this. The first one asks if COGS using a FIFO cost assumption was $400,000 in the year 2020. So it's giving me that non-LIFO COGS. Determine the amount of COGS to be reported using a LIFO cost assumption. Well, if FIFO was 400,000, what did we do down here, right? As I was doing the journal entry, I said, if we're adjusting to a LIFO system, which is what this account is all about, and making this entry for the period, this is an increase to cost of goods sold during 2020 that is not included here because this is the non-LIFO cost of goods sold. So simply to convert, all we need to do is take the FIFO cost of goods sold in this case. And then because we debited, we're adding to that overall cost of goods sold amount that's going to be an expense. So this is the adjustment to LIFO to arrive at my LIFO cost of goods sold. All right. And, just a moment of thinking about, well, reflecting back on the differences between FIFO and LIFO. Remember, LIFO reports more recent higher inventory costs and cost of goods sold. FIFO tends to report the higher costs as ending inventory. So it makes sense that if we're switching from FIFO to LIFO and inventory costs are rising, we have to increase cost of goods sold because LIFO cost of goods sold tends to be higher than FIFO cost of goods sold. And if we're switching from from non-LIFO to LIFO, we're going to have a reduction in our inventory amount because FIFO tends to report the most recent inventory costs as inventory, right? So basically, we're shifting some of that allocation between our inventory account and cost of goods sold, right? Number two, have inventory costs increased or decreased over the course of 2020? I mean, the fair money is always on increase in reality, right? But how would we know? Remember that. So they did indeed increase. And how do we know? It's not really any additional work we have to do, but just reflecting on back, really understanding the LIFO reserve balance. Understanding that this here, this ending balance, is just the difference between non-LIFO and LIFO ending inventory, I have to enunciate that clearly, balances. Right? Well, that makes sense if you really attach meaning to what we're doing in this process. Because this is the non-LIFO ending inventory balance. And the LIFO ending inventory balance would be what we're reporting on the balance sheet. And 80,000 is just the difference between them. And then, of course, similarly, this is the difference between the LIFO and non-LIFO beginning inventory balances. I don't have much room, so I'll just write BI, beginning inventory balance. Okay. So prices must have increased because the discrepancy between LIFO and FIFO, which arises from the difference in inventory costs over time, grew over the year. And so that suggests that the discrepancy between our oldest prices and our newest prices must have also grown during that time period. And the final question